US President Donald Trump recently imposed tariffs on over 180 countries and regions, including allies like the EU and Japan. He's been vocal about the US trade deficit, asserting that other countries have been taking advantage of America.
We just weren't treated right. We were ripped off as a country. I've been saying it for a long time.
But is that true? Let's break down the buzz around the whole trade deficit drama. Okay, first, so what is a trade deficit? Imagine you're buying more goods from your neighbors than you're selling to them. So basically, the US imports more than it exports. But guess what? This isn't new. It has been the norm since the 1970s. And we have to ask, is the trade deficit really that unfair to the US? So, post-World War II, the US emerged as an economic superpower. And in 1944, the Bretton Woods Agreement established the US dollar as the world's primary reserve currency, backed by gold. Basically, the system pegged the US dollars to gold and pegged other currencies to the US dollars. This has made the US dollar super trustworthy. Other countries recognize US dollars as a standard medium of exchange in global trade. Well, the US ditched the gold standard in 1971, and here's a slick move. In 1974, the US struck deals with oil-producing nations to price oil exclusively in dollars. As a result, if you needed oil, you needed US dollars. And it's not just oil that was affected. A 2024 SWIFT report indicates that around 48% of global trade transactions are settled in US dollars. So nations would export their goods to the US to earn dollars. Now, the logic of exchange rate is that when imported goods are cheap for American consumers, US exports become more expensive for foreign buyers, perpetuating the trade deficit. Sounds concerning, right? Wait, there's more to the story. So, countries sell their products to America to get their hands on those precious dollars. But they don't just stash those dollars under matches. They use their savings to invest. US dollars' global dominance means that US assets are considered relatively more reliable. So these countries invest back into the US by buying treasury bonds, stocks, and real estates. This cycle supports US economic growth. While some American factories face challenges due to the so-called trade imbalances, Wall Street and big corporations have been thriving on this foreign investment. And this complex dynamic suggests that trade deficit isn't solely a negative indicator, but part of a broader set of economic relationships. So the challenges the US economy faces might not stem from trade imbalances. And the recent stock market slump could indicate that imposing tariffs might not be a good solution to whatever the problem is. What do you think? Drop your thoughts in the comment.